Hi, everybody. If you're new, welcome. I'm the investing teacher, a high school science teacher that also teaches others how to control their paycheck through trading. I've been successfully doing these strategies for over 7 years now, and I'm the founder of ThetaTraders.com, an online platform that provides one on one and group coaching sessions and option selling alerts. I have provided previous one on one sessions from other clients in the past in this channel. If you find the end of this video helpful, consider joining a 7-day free trial membership at thetatraders.com. Link is in the description down below. Let's get started. All right, guys, so in this video, I want to go over a hedge that I played that ended up being a free hedge. It was a 1-1-2 where you essentially sell a put debit spread, and then you also sell two naked puts that are at a little lower delta than the put debit spread. What was good about the markets last week was MES did go up quite a bit, and I was able to close the two naked puts at the same exact cost as the put debit spread. So we're going to go over how I set up the trade, a possible trade that you could take shortly, a little bit less expiration date if you'd like to, and then it's just different tweaks you could do with this particular strategy. To do some other videos on this on the 111 and how to manage them, and I'll leave a link in the description down below. Let's go over how the trade I did closed on Friday and how it could be pretty beneficial for a good hedge. All right, so let's first look at how to set up a 111 and also a 112 for MES contracts. So in a 111, you're going to buy a put debit spread. So it's going to be a debit, which has to have money in your account to do it. The debit should be around 10 in most cases. You could go higher in your debit, you'd be closer to the money. However, it doesn't really seem worth the risk return profile if you go much higher than the 10. And if you go a lot less than 10, then it's very unlikely to actually get to this max profit. So around debit 10 is a good place to start. It's a 5x multiplier, so you're going to need 10 times 5 or $50 in order to make the trade work. And in order to do that, you're going to look to buy around the 0.25 put option. And then we're going to do a 50 with and sell the next put. And typically we look to look around 30 to 45 DTE. And the trade that I did, it was a longer expiration, and I happen to get a longer dated hedge, but good range is 30 to 45 days in most cases here. Then you're gonna, in a 111, sell a naked put. You want to sell that at around 20, which is double the debit that you spent. This typically ends up being around 0.08 delta in most cases, and it will result in a net credit when you start the position of 20 for the credit minus 10 for the debit, or you'd have a credit of 10, again, 5x multiplier. So you can start this trade at about a $50 net credit. And that's with the 111. The only difference between the 111 and the 112 is we're going to be selling two naked puts. Same credit around 20 would be ideal in a lot of cases. Same delta as well. In this case, you're going to have 2 times 20 or 40 in your credit, and then a debit of 10. So 40 minus 10 would be a net credit of 30. 30 times a 5x multiplier makes a $150 net credit when you start the position. Now, if the trade ends up being profitable, you can just take the profit and close everything. You could either close it at your initial cost, possibly around 10, or you could take a certain percent of your initial credit from the naked puts. A lot of people, and I do this quite a bit, is take profits at around 50%. So if you're getting a credit of 20 on your 111 or 112, I'm going to buy them back at 10 or so. Also consider holding them a little longer and going around 75%. So you'd buy it back at around 5. Now, how do you do this as the hedge? The 1-1 is your put debit spread. And if you set it up correctly, you could make it as a hedge where you essentially close your short positions and then leave the put debit spread 1-1 part on. And you can leave this on for most or the whole duration of your trade. This does help reduce your buying power pretty significantly because if MES starts to drop a bit, this will actually be more profitable. So it does help with other, say, strangles that you're doing or selling naked puts. And if it's set up for the free hedge, it doesn't hurt to leave it on because you already got your buying power back. You could get out of the trade completely if you'd like at any time, by closing the 1-1, you won't necessarily get max profit until you get near that expiration date. So you probably want to wait a bit to actually get rid of your put debit spread. Unless it's near that expiration date, if there's only a few days left, then it might be worth just closing it at that point. What happens if the trade gets challenged? So if MES drops really far and actually gets towards your naked puts at 0.08 delta, I'd recommend manually watching the naked short delta. If it gets really high of around 0.15 delta, or about double what the initial delta was, you can set an alert where MES is about zero point 0.2 delta or even 0.3 delta if you're okay with it going really close to that in the money. If your alert doesn't trigger, you can wait until you collect about 80% profit. And if the alert does trigger, you can look at your profit and loss of that case. Your put debit spread will be profitable, and your naked puts will probably be at a loss there, but you might get a net profit. I typically want to close it if it's over about $30. You can get out of the position completely and then just start it again. So next I want to go over how to set up the put debit spread and your naked puts for a possible trade that could go about 40 days out. Right now we're doing this video on the end of January, so we're going to be looking near the end of March expiration date. And you can feel free to take this trade if you feel like it might be adequate for your risk and returns. All right, so here I'm on Thinkorswim, and we're looking at the MES futures contract. You can go either 30 days out or 47 days out. Either one should be perfectly fine. Just looking at the 47 days out, you can look around the 0.25 delta or so. So 0.25 delta is around 3,900, 3,910 or so. So you're going to end up buying the 3,910. And then we're going to go about 50 width apart. So if I buy the 3,910, I'm going to be selling the 3,860. And then right now the debit says midpoint 9.25, naturals at 18. There's a good chance you might be able to fill this at a debit of 10 or so. So let's look at the Analyze tab on Thinkorswim. Just on the put debit spread, what are the percentages? So here it says negative $50. Obviously, you're spending $50 to make the trade happen. If MES stays above 39.20 or so, and anything higher than that, you're going to lose your full debit on the put debit spread. However, if it gets in between the strikes of 39.10 and 38.60, you'll start to have some profit here. The profit level is right at that 38.90, 3,900 pretty much. So anything lower than 3,900 at the expiration date, you'll be at a net profit on this debit spread. And then the max profit is the width of your strikes. So if you have a 50 width strike times the 5 multiplier, you get $250 in net credit for the trade. However, you did spend 50 to actually place the trade. So 250 minus the 50 would be a $200 profit if it goes between the 38.60 and anything lower than that. As it is now, there's about a 27% chance that it could go this low. So it's a decent chance in order for this to occur. And obviously it's a little bit greater that it wouldn't go that low, but it still is a hedge. Now what we're going to do is add on naked puts. And for the 112 trade, which I tend to do more than the 111, we're going to look to sell 2 naked puts at around a 0.08 delta. That ends up being a 3,600 strike price in 47 days from now. And it's a good chance that you might get at least 13, 14 in your premium. I am making this video on Sunday, so the bid and ask could be a little bit off, but tends to be about a 20 credit at 0.08 delta. So look at the Analyze tab here. And then you have this interesting chart. If MES goes up and pretty much stays exactly where it is, you're going to have a net profit here of about $100 or so. Your put debit spread will expire worthless, but then you're going to be gaining full profit on your MES naked puts. As it goes up here from 3,900, 3,850 to around 3,600, you actually have max profit here because your 3,600 puts would expire worthless, and then you're getting your max gain on your put debit spread. So you can make your $200 on your put debit spread, and then you collect the full premium on your naked contracts. Break-even point right now is around 35.57, and then it could be a big drop if it continues to drop below that. So you want to look at the different ways to manage the trade that I posted earlier. As I go closer to expiration date here in the purple line, you're going to see as I get closer to expiration, the purple will join towards the green. And then as you get near the end of March, you're going to get the exact same chart as you see in the green there. So if you're around here or so, let's say like a week or two out, you might be able to close the put debit spread. Close the naked puts, especially if MES continues to go up. You might be able to close it here at around 50% profit or so, or possibly even more. And then you could keep your put debit spread on. And then if it goes towards expiration and it happens to drop, that would be ideal because you could get your max profit on your debit spread as well. All right, finally, I'm going to go over what I did on my trade. It was a 112, but I did a longer expiration date. And it's set up in my blog. I'll leave a link in the description down below if you want to read through it. In terms of me being able to essentially close the naked puts really early. And I closed the naked puts for the same debit that I used to make the put debit spread. So now essentially the put debit spread will just stay there and it's a free trade. All right, so here's the post on the free hedge of a 112. Recently placed the 112 trade. You buy a put debit spread for about 10 and then sell 2 puts to pay for the cost of the debit. And I decided to close those puts early. To leave some videos there if you want to go into more detail. Started the trade on Wednesday where I sold 2 naked puts. It was 84 DTE. I think it was actually 87 at the time. And I sold 2 at the 34.20 as a 0.08 delta. And then I bought the put debit spread at 3,800, bought the put, 37.50, sold the put. This one had a debit of 9.75, so really close to 10, almost a $50 debit. But then I took in 20 for each of these naked puts, so it'd be a 40 credit total. Now what happened was MES moved up the past few days, and the premium on this dropped very quickly all the way down to 15. If you go from 20 down to 15, it's a 5 net credit. So I could sell at 20, buy at 15 for a 5 net credit. And then if I do that with the 2 contracts, 5 times 2 is 10. And then you would make the same amount in credit as the put debit spread cost. And that's exactly what I did. Filled 2 at the 15 debit. And it was literally on Friday, so only a 2-day trade here. Some of the benefits to the strategy, again, you get your buying power back and place new trades with the funds available. Many times this hedge can be made relatively quickly. I was pretty shocked it only took 2 days on this one. More realistically, maybe 10 to 30 days, depending on what happens with IV and with the actual contract. If you aren't able to make this hedge because the market drops, so for instance, you're getting closer to that loss area, you would still have a good chance of hitting your max profit. And the max profit here was between 34.20, a little bit higher than that, your naked puts expire worthless. All the way to 37.50 is where the end of the put debit spread was right here. But going forward, I probably won't close these as quickly. Very likely I'll let the naked puts decay a little bit more just so I could get some profit on those naked puts. And then you could close the naked puts, leave the put debit spread on, and then you essentially get paid to leave a hedge there. So if the market happens to drop after getting out of the trade, you can make money in multiple ways. One, by selling those put debit spreads, buying them back at a profit, and then 2, making money on your put debit spreads. So in conclusion, while the 112 seems like it's a relatively advanced strategy, it's very flexible. We could close them early if you want, like I did, leave the hedge on. You could also wait to let them decay a little more. And you could also stack these in many expiration dates to have multiple hedges on if you'd wanted to. So if you found any benefit for this video, please like, share, subscribe, all that good stuff. If you're interested in seeing all the trades that I post, one-on-one help and group-minded individuals doing similar trades to this, we're at over 100 members now at Data Traders. You can join a 7-day free trial at datatraders.com. Thanks for watching, everybody, and happy trading.